Oh my God, what is happening to the stock market and what is happening to the world right now? Today we're on Sunday on 29th March. What is really happening? Let's look at the different stocks right here. As you can see, Microsoft from its peak, it's down by 34%. Can you just imagine this number? If we even look at Google, the peak from the peak, it was down by almost 20%. If we look at Apple, the picture is a bit better. However, it's also down by 13%. Nvidia stock, what was really popular over the last 2 years, as you can see from the peak, it's down by 17%. So really, what is happening to this stock market right now? Everything, as you can see right here, is dropping so fast. Overall, the S&P and Nasdaq are down so far year to date by like 7 or 9%. So what is happening? These stocks are even driving the decline even way more than the overall S&P 500 or the Nasdaq. So if we look right here, so let's put Nasdaq price right here, okay? So if we look at the past year, the Nasdaq is down by only 11%, although this is a significant number, of course. However, if we look at Microsoft right here, it's down by 37%. So really, what's happening right here is a change and shift in the trend of the overall stock market, whereby everything is declining right here, and Microsoft and these big magnificent 7 stocks are really driving this downward trend. So let's explore what is happening, and this is what we're going to be talking about in today's video. So why the market is not as strong as it really looks. Make sure you smash the like button because it really helps grow the channel larger. Let's begin. So first, let's look at the graph right here that I've prepared here. So basically, this graph really shows you with a visual illustration how these stocks, their year-to-date performance, not from the peak, but year-to-date. So as of the beginning of 2026 all the way into 29th March 2026. So as you can see right here, Microsoft is leading the loss with a 24% decline from its the beginning of 2026. Tesla, for example, 17%. Apple down 8%, and the overall S&P and Nasdaq, as you can see, overall these two composite indexes are down by 7 to 10%. However, not as much as those other stocks like Microsoft, Meta, Tesla, Alphabet, Amazon, Nvidia. As you can see, these stocks were down by a much more significant value. And as we all know, these magnificent seven they make up a very large percentage of the overall index. So as their dominance grows, their influence overall in the index performance has intensified. However, in theory, their massive market capitalizations should make them relatively stable and close to the index movement. So, for example, right here we have Nvidia. This stock is valued at almost 4 trillion US dollars, and it even reached almost 5 trillion US dollars. So as you can see, a decrease of 11% for this large stock is really kind of out of what we've been used to, and this is kind of the changing in dynamics of the stock market overall. So overall the S&P is down 7%. However, this large cap company is down by 11%. So expect these companies to kind of be more stable, kind of pulling down or pulling back, something similar to those numbers. However, there is a very large disparity between these and those. So now we go on to say that the result is what looked like a mild correction at the index, which is 7 to 10%. However, for these companies, this is what we really call a bear market. So for example, Microsoft is down 24%. This is a bear market for Microsoft. For example, a Meta, for example, or Facebook, they are almost down by 20% as well. And this really is the definition of the bear market. So if we really zoom in into the different definitions of the stock market corrections, so as you can see, a 5% decrease is what we call a pullback. A 10% decrease is a correction. 20% is a bear market. And this is what is happening with Microsoft and Meta. So a market crash is a 35% decline. However, it's very essential for you to note as an investor that this is really expected whenever you're investing, whenever you're signing up to the stock market, you're signing up to different crashes and corrections that are expected to happen periodically whenever time goes on. So basically what I'm trying to say is if we zoom in on this place right here. So when to expect the next correction. So on average, the frequency over the past 100 years in the stock market, the S&P and the Nasdaq. So you expect a 5% pullback every 1.1 years. You expect a 20% or a bear market, a 20% decline every 4 years. Now, if we look at the, for example, if we look at the Nasdaq price over the past 5 years, we can see a decline of more than 20% happened actually in 2025. So that was just, a couple of months ago when, everything was happening in 2025 in Feb. If you guys remember, at that time, everything was down going. In 2021, we've also seen a 35% decline. And if you guys even remember the coronavirus back in 2020, as you can see, it was also down by like 25%. So even in the past couple of years, the number of declines of more than 20% has actually outnumbered the average over the past 100 years. So this really shows you that there is a shifting dynamic in the stock market overall. And also, this shows you that there are multiple opportunities for you as an investor to kind of reap. So another important thing that I would like to highlight right here is, as Warren Buffett always says, is be fearful when others are greedy, and be greedy when others are fearful. So what is happening to the stock market right now is people are really fearful. So what should you be doing right now? You should be greedy, in my personal opinion. So if we look at the, I will be zooming on the place right here. So if we look at the fear greed index, and this, as you can see, whenever it goes to the left, it is extreme fear. Whenever it goes to the right, on the green area right here, it goes to the extreme greed. So basically what happened is the stock market overall is at the extreme fear right now, and this really signals that the overall sentiment for the stocks is really down going, and this means that the bottom is nearing. However, I would not like to speculate right here that the bottom is coming today, tomorrow, next week, next month. I don't know, two months from now, I don't know, and I don't care. All I know, whenever the stocks are decreasing, and whenever I know this company is one that I feel is and that I have actually made my research on, that it is undervalued and it has a good competitive advantage and a good moat, then I would definitely be kind of loading the boat on this company. Whenever it goes down, the more it goes down, the more I buy on this stock. So for example, there are other companies that I've been investing more heavily in the past couple of days. For example, Adobe stock, AMD stock. Intuitive Surgical is one of those stocks that maybe you guys are not really familiar with. However, because of my medical background and because I am a medical doctor, so I believe this company, this surgical company, is really one to benefit from the overall trend in the coming 10 years. So these stocks, I'm buying them at a cheaper valuation right now, and then within a couple of years, you will be seeing us investors be reaping these benefits. So if we go on to the last point right here that I wanted to make is, so some of the current fears are grounded in real risk, of course, because particularly in tensions around the Strait of Hormuz, which is actually a critical route for over 20% of the global energy supply. So we know the gas supply, the energy supply, overall more than 20% of the global demand is taken through that route. So whenever that route is affected because of whatever reasons, so really what happens is you have higher prices and less supply, which leads to, the cascade of higher prices, less profit margins or less overall profits, leading to a decrease in the share price. And this is really something that us investors should be concerned about. If the stocks that we invest in, or if the companies that we invest in, are those that are heavily reliant on such kind of services and products. So if we go in right here, any disruption here would ripple across energy markets and broader economy. This is what we call the ripple effect. Now, higher energy prices can reignite inflation, which was the trend in 2022, if you guys remember back in that time, complicating the path for the Federal Reserve to kind of lower the interest rate. Now, in response, what happens to those interest rates? That these rate cuts could be delayed or could remain higher for a prolonged period. So we were hoping that, this trend of the interest rate, as you can see in 2022 and 2023, when the market was crashing, what was happening to the interest rate? It was going in the up direction. However, after that time, it remained at the same level, and then afterwards, it started trending down. Now, hopefully, we wanted that trend to continue decreasing. However, because of this war that is happening right now, maybe there is a potential that this would either increase back again, or maybe there is a potential that this would remain flat over the next couple of months, which would mean lower returns for those investors and lower appeal to those investors, and leading to less valuations. So elevated interest rates, increased borrowing costs, slowing business expansion, pressuring revenues and profit margins, and ultimately weighing on the stock prices, creating a cascade effect across different markets. So let me know what you guys think in the comments down below. Which stocks are you guys loading the boat on? And I'll see you in our next video.